right. Hello, everybody. We're just letting, we have a bunch of attendees kind of coming into the webinar right now. We'll go ahead and get started. First of all, thanks for being here. Thanks for listening. It's, I thought it was a good time to do a market update, coming out of, one of the most contentious elections and just getting that behind us and now being well into the new administration and a lot going on out there, talks of tariffs and the market, had hit an all-time high and then it has fallen off a little bit, a lot of volatility, just a lot going on. So we wanted to kind of do this today. Also at the bottom of your screen, you should be able to ask questions. You should see that at the bottom. And we'll take a look at those as we go through the presentation. If we see your question, we'll try to address it real time. We may catalog those for the end of the session and get to everybody's questions. So feel free to do that. And I've got Carson and Miles from my office here as well. And we're just going to kind of keep this casual. We've got some slides and some information to share, but definitely want this to be for you all and get any questions you have. Also, we'll do a replay. We'll send those out to everybody in case you missed part of it, that sort of thing.
Good deal. We can get started with the first slide here. I think this is good just for us to look at where the stock market is at this year. We're coming off of the past couple of years where the market was hitting all-time highs, both in 2023 and 2024. 2024 didn't even have an official correction in place, which a correction is top to bottom, the market going down 10% or more. 2024 didn't even experience that, which is abnormal. And then this year started off the year fine, but then basically what happened in mid-February is there was lots of discussion about tariffs. Trump got in office and started deciding to shuffle some things up. Therefore, the market reacts. The market doesn't like uncertainty. So not knowing what the future was for tariffs, the market was reacting and fell off pretty quick. It was a relatively quick correction. The S&P, I think from top to bottom saw 10% entirely, but it's come back a little bit over the past couple of weeks here. But just for the three main indices, the Dow obviously holding up, still relatively flat for the year, and still the NASDAQ and S&P still down 2% and 4% respectively.
Yeah.
So,
and I think the market hates uncertainty, and with talks of tariffs and tax changes potentially and what that looks like, it's just getting a lot of uncertainty at the moment right now. And so that's where the volatility has come from these last 3-4 weeks. But I think it's important to remember that Carson kind of alluded to this, but the volatility is a normal part of investing. What's less normal is the last couple of years, 2023, 2024, when the market essentially went straight up for 2 straight years. That's more abnormal than not seeing 10% pullbacks. Those happen just about every calendar year on average. And it's even a little bit deeper than 10% on average every calendar year.
Yeah, I've done this for, I guess, 21 years now, and I've probably seen, about to their point, what they were just saying, probably 20 corrections, so down 10% or more, probably 5 or 6 recessions or bear markets when the market's down 20% or more. And then, of course, we had 08 where it was down, 50% from peak to trough. So volatility, not to keep hammering this point, but volatility is normal. We always expect that 12, 13% correction in a given year. And then we saw 2020 during COVID, where the market fell 33% in like 30 days, fastest drop in the history of the market. But then by the time clients got a statement or two, they were back up to where they started, and the year finished up 15, 20%. So yeah, none of this is unusual is what we're saying.
good deal. This next slide, it's, we're going to emphasize diversification, I think, for this webinar a handful of times, only because diversification has worked extremely well this year. This is a chart just showing that of the stocks in the S&P 500, all of the nearly 500 stocks in the index, how many are at least 20% off of their 52-week highs. And going into this year, it was pretty low, just over between 50 and 100. And just in the short time frame, up until middle of February or a week or so ago, almost half of the index had their performance down 20% more over its all-time high. So that screams, okay, if you're just owning an index, you're going to be owning all 250 of these companies that are more than 20% off of their all-time high. But it also goes both ways. If you also just purely own an index, you're going to be 40% overweighted to the Mag 7, which again, this year has not performed that well. Yes, they performed well last year, but this just shows that diversification, especially in years where the stock market's down, like in a year where 2022, when the market finished down 20 to 25% during the course of the year, you had nearly every single stock that was 20% or more off its 52-week highs. But some active managers, especially if you're on the value side, they eliminate a lot of those positions.
Yeah, I mean, even look at the end of 2023 there, the market was up, finished up about 20% that year. And I mean, there was over 200 companies at one point that were off off their 52-week high, more than 20%. And so that's pretty incredible. It just goes to show that diversification is very important.
Yeah.
Yeah, even when we look at the different indices and the different markets and how they've performed year to date, this is maybe 2 or 3 days old, but the two worst performing indices are the S&P 500 in purple, and then in brown, the Russell 1000 growth. Both gotten absolutely hammered so far year to date, while there's other asset classes that are doing fine, if not great. Like, for example,
Look at international. 13%.
International. That's right. For the first time in a very long time, we have substantial international outperformance. Now, does it continue? Does it last the entire year? That's the magic question. But that's why we've been severely overweighted to the US the past, I mean, who knows how many years, because that's where the innovation and that's where the earnings growth has come from on the US side of things. But this is a reason why you don't want to completely eliminate your diversification and your exposure to international, because this chart exactly.
Yeah. And I think sometimes you see the headlines like, stock market down 2 or 3% maybe in a given day. It's important to remember that you don't necessarily own just those 500 companies in the S&P or the 30 companies in the Dow. I mean, if you're a client of ours, you're diversified across literally thousands of companies, some of them international, which you can see are positive for the year, in addition to probably some fixed income, which is also up a couple percent and helps protect to the downside.
Yeah, that's big right there. Fixed income being up a couple percent. That if you're diversified, if you've got 60% stock and 40% fixed income, 40% of your assets are up 2% or more this year. That's going to carry a lot of weight.
And I'll say, I mean, I've heard, and it's been a fair question for the last 10 years. Gosh, why wouldn't we just put all our money in the S&P 500? It seems to beat most of the asset allocation models. And that has been the case. But I too remember the lost decade from 2000 to 2010, when the S&P, if you bought it right before the tech crash, had like a negative 1% rate of return for 10 years. So if you had $1 million, you actually lost money in the S&P. But if you had $1 million in these diversified models that we have with small cap, mid cap, large cap, bonds, international, you were up maybe 5 or 6% average rate of return. So maybe $1 million was $1.5 million after 10 years, but it would have been 950,000 in the S&P, and that's a big deal. But then the last 10 years, S&P's beat the pants off of almost every asset allocation. But we saw, like in 2022, the S&P, like Carson said, was maybe down, and NASDAQ was down in the 30s, S&P's down 20. So stocks were probably down 25%, but then some of the diversification models we saw were maybe down 14, 15%. So it's key, if we can lose less in the down years through diversification, and then if the S&P's up 20 and you're up 15 or 16 one year, that's a bet that we'd want to take all day long. It just so happens that this is the first year we're seeing asset allocation, diversification actually beat the S&P again. And again, it's early. It's just it's kind of what you'd expect after 10 years of it not working, 10 or 15 years of the S&P working. It's very possible we go back into a situation where diversification matters. So anyway.
And I think it's also what to highlight dollar cost averaging and why that's important. I mean, David, to your point, the lost decade there, that was a return assuming you weren't dollar cost averaging in throughout the years. If you were doing that and buying in at significant downturns in the market, that obviously also helps performance as well.
That's right.
Next up, there's kind of a lot of data here, but this was a relatively fast correction, what we just have seen over the past 2 or 3 weeks. You'll see a list of some pretty fast corrections, which again is a move 10% or more. This one, it took 16 trading days to move 10%, which is extremely fast. A lot of times it's more of a slower move, but in relative to other times in the market where you have an extremely fast correction, almost every time, 3 months and 6 months later, the overall stock market is higher. 1 month later, it's variable. 12 months later, all times it was higher outside of the tech bubble. So it just means that just because we have a correction doesn't mean the stock market's going to be down 3 and 6 and 12 months later. It does not mean that If you're a long-term investor, it's a buying opportunity, absolutely. But also cooler heads prevail, and take a deep breath and know that this is a reason why you have a team and why we have asset allocation models and why you're not just invested in the S&P 500. But
Yeah, we're not managing to the S&P 500 as a benchmark. It is certainly something we look at, and the average investor is going to always kind of take a look at and say, "Oh, the S&P's up 10. How come I'm up? Well, they're up 12. They'd be happy. How come I'm up 7?" And usually it's like, well, you have 30% in bonds, or you have, XYZ going on. We're managing towards an outcome that we need clients, a rate of return we need them to hit consistently over a 10, 20, 30-year period to meet their goals. So I'd rather say if we can get a 7%, as an example, long-term rate of return with the lowest amount of risk possible. So when there's those 2008 type years, we're not down 40, 50% and spending 5 or 6 years trying to break even. If we can soften those down years, hit our 6, 7, 8% target return, and then hopefully surprise people on the upside, and get better than that, that's a more prudent way to manage, to do wealth management versus looking at the S&P. But we realize that's with the media and what everybody looks at and hears about. We try to coach our clients to look at their customized plan and that sort of thing.
Mm-hmm. Yeah. And Miles, what you were alluding to earlier, just to show how frequent it happens where we have some sort of market pullback or correction. Obviously, you're going to have an intra-year decline of 1% or more 100% of the time. You're going to have days where the stock market's going to be down 1% or more. So on average, it happens every single year. 10%, you can see where 2/3 of all years, there's an intra-year decline of 10% or more. So you can expect on average every year and a half to have some sort of market correction. Now we get into some steeper corrections of like a bear market, which is down 20% or more. You can almost expect like clockwork every 4 years that to happen. Now you could skip a year or something, but on average, experiencing a 20% decline in the stock market, that's the price of admission. I mean, you've got to have the expectation that the market is going to be down 20, 25, 30% at some point during your investment time horizon. It doesn't mean you have to be down 20, 25, 30% if you've got diversification. But the volatility in the stock market is just part of it.
This is a great chart. Seeing like down 50% happens about every 48 years. I've heard so many people in the media say, like 2008 was a 1 in 100-year occurrence. Shouldn't happen again. I mean, the reality is, look, it's every 48 years or whatever. But seeing the down 20% every 4 years, that's interesting to see, because we try to tell them about every 4 or 5 years, you're going to see a decent sized recession, and probably 1 out of 20 years, you might see a really bad market, which might be like down, 30 or 40, which down 30 is happening every 10 years. So that makes sense. So we're saying, we were saying the right thing. This at least backs it up. That's good to see.
And it just goes to show why, I mean, if 64% of the time there's a 10% correction happening, why that's a meaningful mark for if the market's down 10%. It's typically a pretty good time to try and get cash on the sidelines to work, or try and maybe up dollar cost averaging a little bit in those couple months there.
And that's a good point, Miles. We do have clients that'll come to us and say, I had a client today that's like, hey, I have $500,000 of, some sold piece of property, whatever, and I don't really want to throw it in the market today, but I also don't want it sitting in the bank account, and I want to take the emotion out of it. Well, we'll go and say, like, let's put, 200 in today, but then let's keep the other 300 in a money market, and let us kind of watch. If we see these 5% dips, we'll throw in 50 grand here and there. Not going to time it perfectly, but that's strategically going in line with this chart of saying, if we look at averages, if every so often this is going to happen, it's going to be down 10%, and we see it drop 10%, let's go ahead and plug in some of that money and dollar cost average it into the market. So all that works to your advantage, as long as you don't react out of fear and kind of plug and that sort of thing.
Yeah. Let's see, where do we stand with inflation? Inflation has been, I think, the topic of conversation really over the past 2 or 3 years, ever since COVID and the stimulus that the government passed. Inflation was pretty out of control. We're still struggling to get under this 3% range. I think we're right around the 3% range for the core inflation metrics that we're looking at. And what the Fed's trying to do, they've got 2 things they're trying to keep in balance. On one hand, unemployment, and keeping unemployment at a healthy level. And on the other hand, inflation. They're trying to tackle inflation and make sure inflation continues to go down to their 2% target. It's still going down slowly but surely, but can they really accelerate it to the 2% point? That's the magic question. So that's why interest rates, which we'll talk more about a little bit later, haven't come down as fast, because inflation is being sticky around 3%. And unemployment has stayed really low, which is technically a good thing for the market, but they're trying to get that unemployment number up a little bit.
Yeah, I think this is one of the bigger headlines just to keep an eye on. I mean, the fear, and it's definitely not our base case, but the fear is that inflation does creep back up and the Fed versus holding tight or being able to lower rates maybe does need to increase rates. Again, that's not our base case, but it's worth keeping a close eye on
Yeah.
for if inflation does start to trend back up at some point.
I think, this was not to hammer this too hard, but when, we were talking about being overly diversified. If you just own the S&P 500, you've got a 30-40% weighting to the Mag 7. And this chart just shows, when it's going good, it's going great. I mean, look at NVIDIA's return over 2023 and 2024. No one could have expected it. Just absolutely lights out. And then you take that in combination with the other Mag 7 companies during that time, absolutely crushes the S&P 500, and especially the S&P 500 equal weight, just absolutely crushes it. But on the other hand, the Mag 7 year to date as of March 10th, here's the Mag 7 performance. So you've got Tesla, which is suffering the worst, down 45%, NVIDIA, Google, Amazon, all down over double digits, while you have the S&P 500 equal weight down 1%. So it's, they carry a lot of weight, and whenever that weight's being carried upwards, it's a great thing. You feel its impact, but it can also be just as detrimental on the downside whenever there's a market pullback.
Yeah, I think it's worth, we always talk about trying to eliminate single stock risk. You never want to have too much of your net worth in one individual stock. That just shows you can make a bunch of money in the good years. There's the risk of wiping out a huge percentage of your net worth in the bad years. So concentrated stock positions can hold the place in a portfolio, but it needs to be allocated across the entire plan also in a smart way.
Right.
Yeah. And still important to diversify to these names, just not overly.
Yeah, if a client has $2 million with us and they want to own, and they've got everything diversified, but they want to own 50 or 100,000 in Apple and 50 or 100,000 in another name, we're okay with that because we talk about we're taking risks there, but it's still, if one of those stocks falls 45% like Tesla, they've still got the other 1.9 million diversified. That's down 1% in the S&P equal weight versus down 45%. So as long as you have those conversations, individual stocks are fine because sometimes we get best gains from those, but you just have to have kind of a methodology to that.
Right. Yep. And let's just, if we go back over the past 15, 16 years since the financial crisis, I think there has always been something to worry about. Oddly enough, the media has always had something to post about and have bad news about, and to give anxiety to people whenever they're watching portfolios, watching their accounts and watching their investments. There's always going to be something to worry about. But if there's something that I could point out, the trend here is up and to the right. And if that's one thing that the stock market, that the S&P has always done, is that it's never failed to not make new all-time highs. So what that means is, despite all the headlines, despite all the worries that we can incorporate, that we could worry about and stress about our finances, the stock market has always found a way, despite the headlines, to go up and to the right, to shift higher. Now, it's not without volatility. We know that. But there's always going to be a reason to worry, but that doesn't necessarily mean that the stock market's just going to fall out.
As long as you don't sell a reactor in one of those down blips here on this chart, and you have enough cash in your, what we call bucket one, your emergency fund, and you've got some in your other bucket, you've got some bonds sitting in there as well. So if you've got $2 million, in a portfolio, and you've got 300,000 in bonds, during those dips, if you need 100 grand for something, you just take it out of bonds, and we don't sell stocks while they're down. And then you fast forward 18 months, stocks are back up, or we're at an all-time high on the stock market. You need 100 grand to pay off some debt or something. We take it out of stocks and sell at a market peak. Just doing that, I've yet to see, knock on wood, in over 20 years, somebody really mess up a financial plan because of volatility. It's only been, any reaction or any trades they made at a bad time that really messed up a financial plan. So that's why we're so adamant about cash versus real estate versus bonds versus stocks, and getting that ratio right on the balance sheet.
Miles, you want to take the next couple?
Yeah, with tariffs here, are they here to stay or just a headline? I think there's a huge headline risk to tariffs right now. I mean, they seem to be in the news just about every day. I think the hard part and what we talk about here is, one day Trump says they're on at 50%, the next day they're on at 25%, the next day they're on. So it's like, are tariffs here to stay till the end of the year, or are they here till Friday? So you don't want to get caught in the crosshairs of trying to trade tariffs when, I mean, they can potentially have big impacts, but also he's negotiating for something. It's kind of his style. He throws a big number out there. I mean, it's like if you were going to buy a car and it was a $50,000 car, you may you may start at 30 and they're at 50 and you're hoping to land at 40. So it's a negotiation tactic, we think, but huge headline risk to this also. And obviously this chart illustrates that companies are paying attention to it. I mean, the last couple of years, almost nobody was talking about tariffs. Now 40% of companies are talking about tariffs on the quarterly calls.
Yeah. And back to that slide one, the market hates uncertainty. As Miles said, Trump's style is chaotic. And so I'm taking the emotion out in your political affiliation. Just the style is chaotic. So the market's not going to like that. And if you're a business owner or corporate executive and you don't know if tariffs are going to be real or not, it makes it really hard to value your stock forward looking. And, I could see this going a lot of different ways. I could see it just being his negotiating technique, and a lot of these countries back down, and it works out well for the United States. But then again, what worries me is you see China. I mean, they kind of look at it very calculated, and they basically said, all right, we'll go all day, bring it. We'll do this thing as long as you want to do it. And that's where it could get kind of go sideways. So TBD on this, but something we're looking at every day and you're hearing about every day. And it will start to show some sort of resolution, I think, over the next couple months.
Yeah, and just kind of continuing on with headlines. I mean, these are some major headlines that have been at stake since the election back in November. And, the market has remained resilient and climbed higher until the last few weeks here. But, it's our belief that some of these dips are good buying opportunities into the market. And, market can continue to climb higher and to view these pullbacks as temporary and good buying opportunities.
Yeah, the next couple charts is we've already kind of hammered this topic a little bit, but this is just a good chart to put into perspective. Where the market ends up at the end of the year doesn't show the whole year's worth of volatility that could have come. Like, for example, the average annualized performance in the market's close to 10% in this specific time frame, but on average, the market pulls back 14%. So at one point, that is a 24% spread in return that the market has to have by being down at some point 14 and ending up 10%. So despite, we look at 2020 as one of the banner years of this. At one point, the market was down 33% in like 30 days, one of the fastest bear markets in history, and still ended up like 18%. I mean, just wild volatility in a given year. And on average, it's always going to be like that. The fact that we didn't have a correction the past couple of years was pretty surprising that we didn't have the market be down more than 10%.
When we have something like a 2020, that's a very extreme illustration, but it's realistic. That's when we, as your team, we go in and do things like tax loss harvesting. Okay, market fell 30%. Boom, we're going through all of our client accounts and saying, should we sell everything, put it in a shadow model or a similar model to take the tax loss and then stay invested? We did a lot of that in 2020. It's also a time to rebalance as well. Like, you might have started off, 75% stock, 25% bond. And by the end of the year, you're 85% stock. And we may go back and say, let's trim some stocks because our goal is not to be 85%, that amount of risk going forward. So there's a lot of things we do opportunistic during times like that when you have that much volatility. It's also a great time during a 2020 if you have the stomach for it. And we had clients do this. Hey, COVID's going on. We know the market's down 30%. If we got a bunch of money in cash, let's put it into the market. And then they did, and like 6 weeks later, which is very unusual, but 6 weeks later, they had already made a massive return. So those are the kind of things to do if you can just kind of be more robotic. But that's what we're here to help you kind of talk through and use these charts to your advantage.
Yeah, that's good. And lastly, just, whenever the market's presenting times of volatility and you're having a quick correction, more than likely, one of the best days the market is going to have in a year can come after one of its worst days. So on a day when the stock market's performing extremely poorly, where it's down, let's just say 3% in a given day, there's relatively high likelihood that the next day the market could pop 2%. So if you're selling out on a day where the market's down, you have the potential to miss that big climb back, the next day. I feel like that's what was happening during COVID. I remember one day where the market was down like 10, 11, 12%. I mean, just absolutely crazy. But then the next day it would be up 5%. And now there were definitely legs lower while the market was falling out from COVID. But this just goes to show that some of the 10 best days of the year give you some of the most important returns to get to that long-term annualized performance. So just extremely important to be fully invested throughout the year and not try to play the timing game.
Yeah, I mean, if you're trying to time it right, you have to get it right on the front end. I mean, we talk about this all the time, but you got to get it right on the front end. You got to get it right on the back end. So you really have to get it right twice. And the chance of you doing that perfectly, maybe you can do it every now and then or once in your life and it works out well. But the chances of being able to do that systematically time after time, you might be better off going to Vegas.
Yeah, that's true. Really one of the last slides, and then we've got one more about interest rates, and then we'll get to some questions. I know we have some questions lined up here, but back in the 50s and 60s, there was a period, you can see here with some back-to-back years where you had was some pretty substantial bear markets, one after the other. And recently, ever since the financial crisis, we've been in this bull run in the S&P 500, up until 2022 and 2020, where there have been some strong rates of return without bear markets up until, again, like I said, 2020 or 2022. But it just goes to show that it could be the number of days. I mean, you can have some pretty substantial pullbacks, but again, the overall path still is upwards and to the right for the S&P 500. So take these opportunities and know that set your expectations, know they're going to come, and also be prepared with some cash if you have the ability to.
Yep. You want to hop into, go ahead. Last one.
Yeah. Last thing about interest rates. I think if we were talking about this time, March of last year, we were expecting in 2025 to be really aggressive with interest rates being lowered. Interest rates are currently around the current interest rate range 4.25 to 4.5 miles. Is that right?
Yep. Yeah. The top right corner there. That's where rates are at, and expected to stay there through May is what this is saying.
So then for our next rate cut, expectations are June or July for another rate cut. And then, so really where markets are expecting rates to be is maybe one or two cuts this year, maybe. And then next year, maybe one or two more cuts next year. That's the long-term path. It's not like we're going to get to a point where rates are slammed down to 2% and you can get your 3% mortgage anymore. That I think is out of the question, unless there's something bigger at play here that we're just not aware of, unless there's another pretty severe economic downturn. But with rates now, that's why, if you're looking at a home and you're saying, I can always refinance later, maybe, but don't expect to sit here and be getting a 3% mortgage.
I think that 3% mortgage you have is going to be something you talk about to your kids and your grandkids. The way when I first started in the business and clients still had an 11% CD from like the late 80s or whatever. So I think that's going to be one of those things. And more than likely, a refinance might be taking a 6.75% mortgage one day and going to a 5.75. Something like that is more realistic. But again, I've been surprised so many times on both sides in the market over 20 years. But that's what kind of common sense would say right now, to the point of this chart, kind of validating that. So
and I think if you were to see some sort of sharp cut in rates, it probably means economically something isn't going on, because they're having to cut to bring rates down for a reason.
Yeah.
It's not necessarily a bad thing that they're staying elevated for a little bit longer.
Staying elevated in theory should bring down prices of houses. I know we haven't seen that locally, but that more than likely will come. I mean, they're all kind of interrelated, so you have to be careful what you wish for. But we do have, and feel free to ask type questions if you haven't yet. We have a few here. I'll go ahead and jump into one. So, David, I was keen to understand your thoughts moving forward, specifically how you think about investing internationally. As global economists and geopolitical experts continue to signal concerns, is there more than meets the eye when it relates to considering weighting more of the portfolio to less volatile international funds? Great question. So think back to, like, let's say we had a client that had 100% equity portfolio. Very few clients do, but 100 all stock, no bond. When I started in the business, usually somebody it was like half US, half global. So half the portfolio would be global stocks. So some Europe, some, Asia, that sort of thing. And then over the last 15 years, to Carson's point earlier, most of our models and most of the the big institutional models that we track and follow and use to rebalance, we're maybe 80% US, 20% international. So we've been much heavier US for the last 15 years. That's worked out really well, but that 20% international has really been kind of a dud in the portfolio until this year. We're starting to see that turnover. So to this question's point, it's too early to tell, but no, is it worth considering weighting more? Absolutely. I could see maybe now, and depending on what happens with the tariff wars, if Trump really takes us down that path, it could be that the US gets beat up more than some of the more stable European countries. And I would absolutely agree with this. I could see us maybe, instead of being 80-20, you're going back to 70-30 or somewhere in there and adding another 10% or so to international. So that's something we talk about on our investment committee quite a bit. Or if you're the person asking this question or somebody in a one-on-one meeting that has this appetite and we have this conversation, maybe we take some new cash or that sort of thing as a satellite and kind of add some more international to your portfolio while keeping the models kind of the way they are. So that's a great question. I think we're going to have more of those conversations, and I think the answer is yes.
Next, I'll get this next one. Asking about PE ratio when it comes to the S&P 500. It says the PE ratio seems very high, while overseas markets have a very low PE ratio. Is PE ratio a good indicator of relative upside? I think it can be a indicator of relative upside. However, international PE, I think, has been far below the US average PE over the past decade or two. And it hasn't, just because international has been cheap doesn't necessarily mean that international is attractive in the short term. And I think like the long-term average PE ratio of the S&P 500 here in the US is around 16 or 17. And I think we're trading well above that, around 26. Does that mean that the S&P is overvalued? Not necessarily, because we've seen the PE ratio of the S&P extend far higher above that. But does that mean that eventually at some point we're going to get either earnings going to catch up, or is that PE multiple going to come back down to earth to meet those earnings? That's the magic question. So I think, kind of echoing what David said, that there's absolute balance to being diversified between US and international, and that international is becoming more attractive to lessen our overweight to the US and increase our kind of underexposure to actually get back to a higher exposure in international now.
Yeah, because
I'll say to an extent, some of the PE ratio on the S&P 500 it's kind of drawn out a little bit by the Mag 7. So if you look at like the equal weight, or if things start to broaden out, I think you see that PE ratio come down a little bit more in line with the long-term averages.
Another question, I think this is the last question. While I believe past is prologue, when I try to stay positive and share a positive long-term outlook with others, based on history, the response is typically yes, but we've never seen anything like what's happening now politically. So can we really rely on history? Thoughts? Great question. And I'll say this, I agree. I mean, I feel that way too. I mean, it definitely is different and feels different now. I've also heard that exact question and thought multiple times, like with COVID and with, 2008, like this time feels way different. And it has multiple times, and it's always kind of reverted back to a mean. But I mean, again, until it doesn't, right? I mean, where is that point that we have, like the Great Depression where it fell, like 80%, 70, 80%, and then it took about 4 or 5 years to break even. We haven't seen that in 100 years. So heaven forbid that's the case now. But it does feel different politically. We're becoming more and more contentious politically. Data travels faster. Countries are more on edge. There's a lot of those things going on. What I've seen, though, is because of that cadence, you're just seeing the market reacts faster. You have the market drop 10% in a few days, whereas it used to take 6 months. And then it also comes back quicker. So yeah, all we have is past to rely upon, but we also have to look at the current situation and then try to balance that out. And that's where if a client is really, really nervous and says, I really don't feel good about this to the point I'm losing sleep at night, we'll take all that into account and say, okay, we've got to use past, as some sort of, reference, but you're really nervous about things. You're 70% stock, 30% bond. What would it look like if we went 60-40 or 50-50 to kind of meet in the middle and not, odds are against you that the market's going to go down and stay down for longer than it ever has. but let's give a little bit of padding there if it makes you sleep a little bit better at night and still keep half our money in the market. So having those conversations are important. I could talk all day about that. Great question. It's just been scary out there a lot of times. And this is definitely new. The headlines are new and a little different. But I still wouldn't make major financial planning changes based upon that. But I would definitely have this conversation with us offline in your next planning meeting. And if anybody else is listening and feels this way, certainly reach out to us and we can kind of go through this. But it's definitely more of a customized thing. So those are great questions. I don't see any others. Yeah. Anything else?
Yeah, I think, just as a last note to add to that, the success of a financial plan is not dependent on, whether or not you're going to make 6.5 or 7% annualized rate of return. The core success of a financial plan is the planning that you do throughout your work. How much are you going to save? What retirement accounts are you putting money into? What's your spend level? How much are you going to need to live off of your investments? That's where your success in a financial plan is going to be. How much cash do you have in the bank? That sort of thing. Outside of who's president, we can only control the things that we can control. And we can always make sure, A, we've got enough cash in the bank, and B, we've got enough fixed income and bonds to withstand any sort of market correction so that we don't have to be put in a point where we have to sell stocks while they're down. So it's hard, investing money, it's emotional. Me, David, Miles, we all have emotions. We all get emotional seeing the market go up and down and all around. But the bottom line, we talk it out. Talk through our emotions, how we're viewing the stock market. We decide, okay, what's the best decision that we can make? Not in, while still being aware of emotions, but not necessarily making decisions off of emotions. So, yeah.
Good stuff.
As always, this will be recorded. We plan on having this up on our YouTube channel here within the next week or so. Feel free to share it with anybody, and we'll also have an email out. But anything else, guys?
No. Appreciate
This was good.
Appreciate your time. We'll talk
Thanks
soon.
everybody for
Call
joining
if you need
us.
Yep. Thank y'all for joining us, and we'll see you next time.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.